Amy, right? I mean, let's be clear about what we're talking about here. So if the banks if rates pause and then the banks pause, and then you've got a real window of, I don't know, 8-9 months for these tech stocks to start working again because everybody's all scared about where rates are going. Look at what banks have done over the last 3 months, OK? It tells us the whole story of the market. Bank of America is up 33%, Citi 23, Goldman 41, JP Morgan 28, Morgan Stanley 29, Wells Fargo 37. Why? Because rates have gone up, as Steve said, in lockstep.
I wish you were going to be right, and I wish Tony was right, but I don't think that's the case. I think rates are going to continue to go up. I didn't realize until reading his note this morning that it was been the fastest 10-week rate of change in history. So they're certainly going up faster even than I expected, but I don't think we're going to get an 8-month pause here, or even I think we're going to be above 2. Probably in the second quarter. I think we're going to continue this march higher because the fundamentals warrant it. I mean, we have incredible fiscal stimulus. We still have an easy Fed. We heard from Powell on Wednesday. We have vaccination rates that are increasing. The growth is going to be strong. That's going to drive a steepening of the yield curve. I think that's still going to help the financials. At some point, it will reverse and it will stop, but and I don't think we're there yet.
I mean, you have JP Morgan and Goldman Sachs, so you're right in the game here.
Right. We're right in the game. We've been underweight financials for a really long time. At the end of last year, we saw this coming and we went market weight. I still think long term, there's too much capacity in financials. I think some of the new entrants are going to be competitive. On the margin, what the Fed announced today with the SLR is a negative for them. So I don't, I'm not making a huge bet of the portfolio from a long-term stance on financials, but I do think we are in a steepening cycle, largely driven by stimulus. And, we're going to have really strong growth. And there's, 1.7 just doesn't make sense, in my opinion, as the place for the 10-year to stop.
I mean, Degas, you've got, according to Bank of America and their fund flows, which we like to follow all the time on this program, record inflows into global financial stocks over the past 4 weeks, right? I mean, the money continues to go there, regardless of calls like Dwyer and whether you think rates are topping out. Follow the money. The old adage, the money continues to go into the financials and into the cyclicals.
Yeah, Scott, I'm going to go off of what Amy just was talking about. The money center banks are doing well in this short period, as you said, the last 4 weeks. What we're really seeing is that, will the money center banks be disrupted? And we're seeing that happen with PayPal, with Square, and also with the card, like MasterCard, for instance, Visa. We talked about that last time I was on. This is the direction that money is really flowing, and the tide is really becoming more disruptive against these money center banks. This may be a short trade, but we think the longer term play and investment would be into companies like a PayPal, companies like Square, MasterCard. These are the companies that we think the tide is really turning towards as we look at disrupting the money center banks.